And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the show. My name is Al Gordon, and as always, I'm working on your financial freedom. And what we're going to do today is we're going to get into my time capsule. And you and I, we're going to go back to February. And what I'm going to do is I'm going to paint a big picture for you regarding what has been happening in the real estate markets. I'm going to take you through a timeline, and we're going to start with February 16th. What's so special about February 16th? I mean, it's not Valentine's Day. That's on the 14th, right? And you are correct. What happened on February 16th, though, was kind of amazing. An article was written by a gentleman by the name of Jacob Wallace. He writes for an organization called BizNow. And this article caught my eye February 16th. Commercial and multifamily lending may surpass $1 trillion for the first time in 2022. Why is that significant? Well, what that tells us was that money was flowing into the multifamily and commercial spaces. Now, Lifestyles Unlimited, we don't focus on any commercial real estate other than multifamily. There are very specific reasons why we do that, but this is amazing. That forecast predicted that 2022 would be the first mortgage borrowing and lending year that will surpass $1 trillion. That means money's flowing into multifamily. Why is that happening? Well, in February of 2022, we started coming out of the pandemic, did we not? The stock market, what was it doing in February 2022? It started its decline. Yeah, if you look at a stock chart, the thing that strikes me amazingly is that when you look at what happened in, say, February of 2022, the markets were adjusting downward. They had already topped, and we started seeing the value on the Dow Jones Industrial and the NASDAQ, as well as all those other indexes, starting to fall. Well, that money was going into real estate. I totally make the correlation. The other amazing thing is this. The projection was that the total volume for commercial and multifamily properties was expected to increase 13% over the previous year. So money is moving away from those stock markets, and money is moving into commercial real estate, both in debt and, like I do, in equity. And I use that debt to leverage my asset so that I can control all the equity in that asset and make great money for myself. And you can do it too. We'll show you how to do it. Let's jump back into the time machine. You ready? And what I'm going to do is I'm going to take you forward a couple months. We're going to go to April 12th of 2022 because there were some things going on in April that really, if you didn't know about it, well, you didn't know about it. And that's part of the reason I'm bringing this up. My buddy Bendix Anderson, I quote him a lot on the show because he's in the Get It Club. He writes information that people like you and I can actually use. So what did he say? He said in April 12th, multifamily deals continue to pile in during a busy first quarter. Amazing, right? 2 months prior to that, back in February, they were talking about all this money that was rushing in to the debt side. In other words, the lending side of commercial real estate. And we fast forward about 2 months and we find out the multifamily deals are continuing to pile in during a busy first quarter. And what was going on in the stock market? Oh, let me go take a look. Let me pull up the stock page for today on April 12th. It's not pretty. Now, in April, the stock market had gone down a little bit, but it kind of came back a little bit. But you know what it started doing again? It went back into its old habits. It started dropping again. Yet Bendix Anderson is telling us that skyrocketing rents are continuing to drive interest from investors of all types towards multifamily properties across the country. This is amazing information. And did you pick up on the information that you didn't know about? Okay, let me go back to that statement that Bendix said. He said skyrocketing rents. Okay, rents had been going up. They had been following the inflationary pressures occurring in this country. Like inflation or not, it doesn't matter. It's here. We're dealing with it, and it is driving our rent prices up because Rents are market driven. Yeah, they're market driven. I charge what the market will bear. I don't go full. I come down just a notch because I want to give people a good value, but I charge market rents. And if market rents are driving up, well, that's what I'm going to do too. I'm not in the business of charity, although I do contribute to charities. But here's the thing that really strikes me. Investors of all types are buying multifamily properties. That means people that were invested in the stock market are buying multifamily properties. People that were invested in other assets, I don't know, gold, silver, whatever's out there, whatever people buy, they're starting to buy multifamily properties. One of the concerns that we had in April as Lifestyles Unlimited members that invest in multifamily properties, we were starting to see a little bit of a scarcity of properties to buy. A scarcity of properties to buy. Yeah, because everybody was all of a sudden in the market competing with us. Now, at Lifestyles Unlimited, we have a system in place where we do not compete with each other. It is a very viable element and a very important element of our what we call our preferred investor group. In other words, the people that want to invest in syndicated multifamily deals, they're all a part of this group. The reason this group exists is because the Security and Exchange Commission mandates that if we're going to do business this way, we have to be a part of a closed group. In other words, there has to be controls on who goes into that group. And in that group, everybody in that group is a sophisticated investor. In other words, everyone has gone through the very specific training that Lifestyles Unlimited provides to teach them how to do this correctly. There's also a component in there, well, we call it the lead investor training. And what it does is it's very specialized, very intense training that will teach you how to correctly syndicate multifamily deals to your fellow members. You're in the time machine with me. We're on April 12th, and what we're doing is we're taking a walk through the timeline of real estate because I want to educate you on the trends that have occurred. I mentioned to you, I don't know, last week or earlier in this show, I can't remember what I've told you because I want to fill your brain with as much as I can. I can't even remember what I've told you, to be honest with you, because I just want you to understand there's a better way to achieve retirement and the lifestyle you're trying to achieve. And I know this because I've done it. And I'm surrounded by people that have either done it or they are in the process of doing it. And I want you to be a part of that process. All right, so we were talking about an article that Bendix Anderson wrote back in April 12th. And he was talking about all kinds of investors are coming from all kinds of other investment vehicles, and they're investing into multifamily properties. They're investing in multifamily properties because people are hearing the buzz. People are reading stuff like I'm reading stuff. People, not everybody listens to the show. Believe it or not everybody listens to the Lifestyles Unlimited Real Estate Investor Radio Network, and they just don't know what we provide. Yet they get exposed to information, and then they act on it. They're looking at their stock accounts, and they're going, oh, that's not pretty. It's going downward. What shall I do? Well, depending on where you are in your investment journey and how close you are to your so-called retirement date, this could be a total disaster for you. The stock market could be a total disaster. It could be putting you in a place where you are forced to dollar cost average. Like all those younger people are like, oh, stocks are on sale. I'm not going to retire for 30 years. I could ride this out because their financial planner told them you can ride this out. It might take 7 years. It might take 8 years, but the stock market will come back. And because stocks are on sale, you'll be in a better position. And that's all fine and dandy unless you were looking at retirement in the next 5 years. Now, your whole retirement journey has just been thrown off the rails. So some people go, I can't do this. I can't ride this thing down. I'm too old. So what do? They call up their broker and they go, so I'll put it all in cash. Just let it sit there in cash. That way, at least I have the cash and the value of the stocks as they continue to go down won't affect my balance. My balance will sit there in cash. But here's the problem. While your money's sitting there in cash, it's not doing anything for you. It's not earning you more money. Now, granted, it's not losing you any more money. I get that. But it's not earning you any more money. Oh, inflation. Remember inflation? Yeah, that thing that's happening right now and on April 12th, and this is not April 12th. I'm just telling you we're in the time machine. I don't want to confuse you, okay? Inflation, well, people are starting to notice inflation. They're starting to notice that things are costing a lot more, and it's happening very fast. They're going to the grocery store. They're seeing the price of chicken go up. They're seeing the price of meat go up. They're seeing the price of all the other goods that they buy in the supermarket. Everything is going up in price, except for the rotisserie Costco chicken. I went and bought one of those yesterday. It was the same price. I was like, holy smokes. Costco, wow. They are still giving me that big, massive, well-cooked bird for under $5. And then I went to go buy some shredded cheese, and I realized the price went up $5. So I know where they're making it up. Yeah. Okay. But let's get back to this point I want to make. This point I want to make is that when investors decide to change their asset class, they invest into something different. When somebody decides they're going to move from whatever asset class they're in, and they're going to go buy multifamily apartment communities, there's really two ways that they can do it. There's two ways. They can just go out and buy it, pay all cash or get a loan. Maybe they have, whatever their resources are. They go out and they buy that asset. They hire a management company to run that asset, and hopefully they're meeting their metrics. But here's the problem. They are not properly educated on the process of buying the property. They're not properly educated on the process of renovating the property. They're not educated on the process of operating the property. Most of those people really don't know what they're doing. They're counting on a third-party manager to do all of that for them. And here's the problem. The third-party management company, they will do whatever minimums are necessary. And unless you tell them that they have to do certain things, they're going to do the basics. And if you don't know what those certain things are that you want your third-party management company to focus on, it will not increase your net operating income, which will not increase the value of your asset. Okay? Now, believe it or not, some people will buy these things and they're okay with minimal returns. They just don't want to lose money. And that's fine. That's totally fine. In 5 to 10 years, I will buy that asset from them because that asset will be underperforming in the marketplace because they don't know how to operate within the marketplace. Yes, you heard me correctly. People buying assets today are preparing me to buy those assets from them in the future, knowing full well that they don't know what they're doing, but I do. And as a result of that, I'm going to make great money in the future. Yeah, you heard. Now that sounds like I'm a big meanie, huh? Sounds like I'm picking on somebody, huh? Well, I'll tell you what. They put their big boy pants on, they got in the ring, and they decided to dance. And you know what? They might get knocked out. They might get knocked out. They might knock me out. I don't know. Don't know. Time will tell, right? Okay, here's the other thing I want to share with you. Some of these people, well, they don't want to go out and buy the asset all themselves. Either they don't know how to, or they don't want to, or they just plain can't do it. Okay? So what they'll do is they'll go on the internet and they'll start looking for people that maybe they can invest with. And trust me, there are a lot of people on the internet that you could go find, that you could go make a connection with. You can go to LinkedIn, you can go to Facebook, you can go all of those places. You can find people that say, I am a real estate investor and I will let you invest with me. And you know what these people that are investing in these properties back in April 12th were doing? They were giving their hard-earned money to these people because you know what these people said? We're going to give you a preferred rate of return. And you went, really? A preferred rate of return? What does that mean? Well, what that means is we're going to give you a guaranteed 10% cash-on-cash return. And you're thinking to yourself, wow, 10%? That's actually really good considering what the real estate market's doing right now. So you buy into that asset and you hold that asset for, I don't know, let's say 10 years. And you got a 10% rate of return every year. It was guaranteed. They got to the end of the 10 years. They sold the property. And what did you do? Well, you got a 10% rate of return over 10 years. So effectively, you doubled your money in 10 years. And here's the problem. That's a terrible way for you to make money. It's because that person that sold you that opportunity for you to invest with them, they stripped out all the profits. They stripped everything out. That asset makes way more than 10% rate of return. But because they sold you on a 10% rate of return, you bought it, that's all you get. We come back from the break, we're jumping back into the time machine because we've got to see what the future holds.
Got questions? Call Lifestyles Unlimited at 855-497-4335. The Real Estate Investor Radio Show continues next.
Stop waiting. Stop sitting around. Stop procrastinating. This is your time. Make it happen. Do it now. When's the best time? Now. People go, well, I don't know. It's going to crash. It's going to be better next year. I've got to listen to 4 more classes. I love guys come up to me all the time. You know, I've been listening to you on the radio for 8 years now, right? I go, and you're not rich yet? Well, really, I'm thinking about joining next month. Do it now.
Learn the skills you need to retire with real estate in 5 years or less. Do it now. Register for the Lifestyles Unlimited free online workshop, lifestylesunlimitedworkshop.com.
Let me make one final point that actually Bendix Anderson made on April 12th. Remember, we're in my time machine. We're back in April 12th. We're reading today's headlines. Bendix says this: on the heel of record investment sale volume on multifamily properties in 2021. Okay, so people were buying multifamily assets during the pandemic. Trust me, people were becoming very aware that real estate was the asset class to be in. Very, very clear, because there are people that actually understand market forces. There are older people like me who have lived through some of these market events. As a matter of fact, there's a ton of Lifestyles Unlimited members that have done just that. They've watched that 401k shrink down to a 201k, only to sit forever to wait for it to come back, and then they think everything is jolly good until it does it again. Well, that's kind of what's going on in the markets now in April, because the markets are actually getting ready to fall. Yes, remember, in April 12th, we can't see into the future, but because we're in my time machine, I actually have access to future events based on where we left. Yeah, I know, that's kind of cool, huh? And what I'm seeing, I brought those stock charts with me, and I'm like, oh no, this is not looking good for people that are heavily invested in the stock market. Now, the final point that Bendix makes is that there were indications that deal volume continued to flow during a very busy first quarter of 2022. So that's what Bendix was reporting here on April 12th of 2022. Let's do this. Let's get back into the time machine, because there's a report that came in from Marcus and Millichap. Now, Marcus and Millichap is a Lifestyles Unlimited vendor. They're part of the Lifestyles Unlimited team. When you become a member, this is an organization that understands what we do as far as real estate investing, and they make their services available to us. As a matter of fact, they want to work with us because, as I mentioned earlier in the last segment, those of us that invest in multifamily properties, we are absolutely sophisticated investors, and the majority of us are accredited investors. What's the difference? Well, there's no difference between the two when it comes to educational content. Yeah, sophisticated and accredited, they both require you to have knowledge of what you're doing, okay? The accredited piece is just something that the government lays out that says, if you make a certain amount of money or you have a certain amount of wealth, if you meet certain asset tests, you are an accredited investor. It's just that simple. It's just a financial component. And so with these deals that you might find on the internet. I got one, believe it or not, people send me deals from outside of Lifestyles Unlimited because they listen to the show and they figure, well, Al would think that this is a great deal. So I was looking at one of these deals, and it's a terrible deal. It's the deal I told you about in the last segment. It's that 10% preferred rate of return. And here's what I know. I just went to a case study. Okay, in the future, I'm going to go to a case study because we're still in April, right? Okay, we're not. Am I just messing with your brain now? I am. I'm messing with your brain. Okay, so in the future, I'm going to go to a case study, and I'm going to watch Kelly, who's a Lifestyles Unlimited member. She's a lead investor. She's going to talk about her asset that she bought in South Texas, actually down in the Corpus Christi area. And what she did with this asset was, well, she completely turned it around. In a 5-year period, she returned an average of 34% per year to her investors. Now compare that to that quote unquote preferred 10% rate of return. And ask yourself this, where's that delta going? Where's that 24% difference going? Well, it's not going to the people that brought all the money to the table so that person that syndicated that deal could syndicate that deal. It's going to that person that syndicated the deal. And that's the problem with buying into deals on the internet and not being educated on how this whole process works. Because the slicky boys out there, they make it look like this is a great deal. It's a great deal. 10% rate of return. I'm not getting that in the stock market. Certainly not getting that now. But see, what you don't understand is that there are other assets you can invest in that'll give you a 34% rate of return. Imagine how fast you can get to retirement at 34% rate of return versus a 10% rate of return. Yeah, that 34% rate of return that I'm talking about, that doubles your money in 3 years, not 10 years. 3 years. I think that's a better asset class to be in. Well, it's the same asset class, but I think that's a better asset to be invested in. Does that make sense? I know it makes sense. Okay, so Marcus and Millichap, man, they came out with a big report. And this is what they said. On Wednesday, March 16th, now they're talking about the past in the future. Well, okay, right? Okay, so on Wednesday, March 16th, the Fed approved a 25 basis rate increase. The first since September of 2018. Do you remember when that happened? Remember? And what happened? As soon as the Fed did that, they raised it 1/4 point. The Mortgage Bankers Association lost their minds. They totally lost their minds. And they recommended that lending rates should go up 2 full points. You heard me correctly. 2 full points. Now, you think the government had a hand in that? Yes, the government had a hand in that. Because what the Fed said was they were going to raise the discount rate. Okay, that's the rate that banks pay when they borrow from the Fed. Okay, you and I can't borrow that money. Those interest rates that they talk about, that's not available to you and I. It's not. The Fed also said they were planning to make up to, what was it, 7 interest rates over the year? Okay, interest rate raises over the year. And as soon as they signaled they plan to do that over 2022, the Mortgage Bankers Association advised the lending community, jack your rates up. Rates went up 2 full points. What does that mean? It means I was paying 3.75% for money for houses I was buying prior to March 16th. After that happened, my price of money went up to like 5.75%, like overnight. And you know what that did to the market? Well, here's what it did to the market. It destroyed the dreams of many people that were looking to buy their own home to live in, maybe their first home purchase. And how did it crush their dreams? Well, it reduced their buying capacity because those people, well, they have to get a loan. They can't pay all cash. Most people can't pay all cash. There's only some very rare instances when you should be paying all cash. I'm not going to get into those now, but the point I want to make is that many people that, let's say they were they were loan size. They were qualified to buy a house up to $250,000. That was their maximum amount that they could purchase. So what are they looking at? They're trying to get the best property that they can, right up to that $250,000 price point, right? So they're making offers and offers and offers on property after property after property. And they're getting outbidded by all these California cash bidders that are coming in, right? So now all of a sudden, the Fed raises the rate, and now they can't afford a home valued at $250,000. Now they're loan sized for, let's say, $205,000. So what it did was it completely took them out of a market that they could buy in, and it put them into a different market where their options are reduced. The size of home is affected because there is a difference between a property that is priced at $205,000 versus a property that is priced at $250,000. We all know this. Now they're raising the rates. They're pushing people out of the market. Now, investors, we haven't been pushed out of the market. Let's jump back in that time machine. I need to take you a little bit farther into the future, into April. We're only going to go about a week. It'll take just a second. So jump in. We're going to go to April 19th. And guess what? Bendix Anderson, man, he wrote another article that I actually talked about in April on this show. Here's what he said. Class A renters are seeing the biggest rate increases today. What does that mean? Okay, what is a Class A renter? A Class A renter is somebody who wants the best of the best. These are the people that would rent, say, in Trump Towers. Does that make sense? Or these are the people that go and they rent in these brand new apartment communities that get built around your municipality. Yeah, that's what a Class A renter is. These are the people that pay the top end of the market rents. So what this is saying is that there's a few signs of affordability ceilings in the market rate apartment segment. Okay, this is what that means. People can only afford to pay so much. So when these people went into these Class A properties, maybe they went in paying the maximum rent that they could afford, but they wanted the luxury associated with living in that community. Maybe it's a symbol thing, maybe it's just a comfort thing, maybe it's a myriad of things, maybe it's just a convenience thing. People rent properties for various reasons, but Class A properties, the values of the rents were going up. So here's the thing. Let's say you're a Class A renter. Let's say you're paying, I don't know, let's go with a big number. Let's say you're paying $3,000 a month for your unit. And you've been in that unit for, 11 months. And now you get a letter from the management company saying, "Dear renter, we would like to know if you're interested in renewing your lease. If you are, here are the terms and conditions we're going to offer you." And in that letter, what the management company is going to offer the resident is a rent bump. They're going to raise the rent. That's part of how we make money in real estate. It's also how we stay ahead of our expenses, because our expenses are also doing what? Well, they're going up too. They're also affected by these inflationary pressures. Yes, they are. So let's say it's a 10% increase. I'm not saying a 10% increase is standard for the industry. I'm just making the math easy so we can follow it. So now their rent, if they want to stay there, is going to be $3,300 a month. Maybe they can't afford $3,300 a month. So what do? Well, they move out of that unit. And where do they move? They move to another apartment community that maybe is as nice. Maybe there's something they give up. Maybe it doesn't have the dog park. Maybe it's like an extra mile away from work. Who knows? Who knows what the reasons are? But they're able to buy into the next apartment community for $3,000 a month. And maybe this apartment community is what we call a Class B property. Maybe it's about 10, 20 years older than that Class A property. It's still in great condition. It's not as close to all the new things going on in the community, but it's still great value. Oh, and maybe that's owned by a Lifestyles Unlimited member. So what happens is we inherit the residents from the higher class asset into our asset as prices are going up. As Lifestyles Unlimited members, the majority of the assets that we target are considered Class C properties. Yeah, these are older properties. They've gone through a couple of life cycles. They're probably a little tired, a little worn out. They need to be modernized. They need to be updated. They need to have that beautiful feeling that they had when they were first constructed. And most people don't know how to do that, but we do. We know how to do that. We go in, we buy that asset, we renovate that asset, we bring that asset back to its glory days, we put those units onto the marketplace, and they compete spectacularly with other units that are similar. And we attract the best clientele because we offer the best product at the best price, so we get the best people. That's just the way it is. I'm not worried about rents going up. I'm really not. Because as I push my rents up, I will attract residents from higher class properties because they can no longer afford to live in those properties. In April, well, let's call it April 30th. Jump back in the time machine. I got to take it to April 30th. Okay, we're here. Ready? CNN, Tammy Luby, Luhby. I want to get it correct. She wrote an article that said inflation spurs record decline in wages and benefits. Okay? Workers were getting hit. This supports the argument that I just made. Yeah, the argument I made a couple weeks ago, because we were in the time machine a couple weeks ago. Yeah, she's saying inflation spurs record decline in workers' wages and benefits. That means people were losing money. Maybe they took a pay cut because of what's been going on in the economy. Now, since then, I've actually disproved Tammy's statement. Now, when she wrote that, it was accurate. Wages did fall. They did fall because of inflationary pressures. But as I pointed out last week, overall, wages have actually been keeping up with the rate of inflation, which is very good for us as real estate investors. And it's very good for our residents, especially those residents that maybe would have to look at moving, because let's be very clear about moving. It's terrible for the resident because it takes all your time. It costs money. You wind up breaking stuff that you like. That's just the way it is. And for the real estate investor, it's terrible because now I lose a resident that was a great resident. They paid on time. They took care of the property. Now I have to go into the unit and I have to look around. I have to see, is there anything that needs to be taken care of so that we can bring back that luster? It might take me a day to do that. It might take me a week to do that. It just depends on the condition of the unit. But while that unit is down, it will not provide me income. That's a problem. So we want to get that unit turned as fast as we can, and then we want to go out and find that wonderful resident that's going to move in. Those two things right there, well, they cost money. They are an expense. So moving is not something we ever want to encourage our residents to do, because not only does it affect us economically and financially, it affects the resident because their life gets disrupted by the moving process. So many times, great residents they'll find a way and they'll just make it work. They will make it work. Now, the last thing that I want to do is I want to tell you about the housing market. Jump back in the time machine. I actually have to go back to April 20th. I know I kind of jumped ahead. Let's go back. That's the beautiful thing about this time machine. Jackie Sidler's and Bloomberg magazine, well, they wrote an article that was published in Fortune. I know, it's weird. On April 20th, they said, you thought the U.S. housing market was overpriced? It's actually been named the most affordable major country for middle-class home buyers. Yeah. Isn't that crazy? And then I looked at this thing. I'm like, well, okay, so what are the most affordable cities? They said Pittsburgh, Oklahoma City, Rochester, New York, Edmonton, Canada. Well, okay. And St. Louis. Oh, St. Louis? There's a lot of Lifestyles Unlimited members in St. Louis. As a matter of fact, we just did a 2-day. Well, we will do a 2-day in the future because we're still in April, right? But in June, we'll actually do a 2-day. That's our financial freedom course on location in St. Louis for all of our members that live in that greater area. And I'll tell you what, they're actually going to start buying a lot of assets in St. Louis because that's actually a market that is ripe for Lifestyles Unlimited members. Now, then I was curious, okay, so if those are the most affordable cities in the world, and one of them's in Canada, what are the least affordable? Oh, man, here they are. Hong Kong, Sydney, Australia, Vancouver. I was in Vancouver. It's beautiful, but it's pricey up there. Oh, here's an American city. San Jose. Yeah, the Bay Area. 4th least affordable place on the planet. And the 5th one was Melbourne. Okay. I'm not going to buy real estate in San Jose. I've done shows on that. I've talked about how you can make much better money buying assets elsewhere that produce better rates of return than you can buy assets in California and sit on them, put a lot of money into them, they probably won't cash flow. And if they do cash flow, you had to put so much money into the property to get it to cash flow. Now you're sitting on what's called debt equity. Debt equity is not good for your investing, because essentially what you have is you have a battalion of soldiers that are taking a nap. Yeah, that's it. They're just taking a nap. They're not doing anything for you. You need to get that battalion into the war fight working for you. That's what this is all about. That's why I put you into this time machine, because I wanted you to see how real estate has transacted over the first part of this year. All right, check it out. Let's jump back in the time machine. I'm going to take you back to present day. Poof, we're here. Okay, how was that? Did you learn something? I hope you learned that real estate is an incredible asset. It is an incredible asset class. We specifically choose residential income producing properties. We do. And there's two markets. There's two markets. One of them's a commercial market. The other one's a non-commercial market. I don't want to get into the details as to why one's one and one's the other. It is what it is. Those two asset classes made Lifestyles Unlimited members massive money through the pandemic. And we are now poised to make more money. We want you to be a part of what we're doing. Go to lifestylesunlimited.com and let's get you started.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.